Good morning, everyone. Thanks for joining us. O'Connor and Drew, I'm Ryan McDonell, one of the tax managers. We just wanted to shoot out this quick webinar, probably right around a half hour or so. The PPP Flexibility Act of 2020 just passed the Senate the other day after it passed the House last week. In general, it's very borrower friendly. I think it's going to help people move closer to reaching 100% forgiveness. I think it presents some good opportunities for borrowers to really maybe step back from the details and look at where the program stands and realize that they've expanded the rules so that restoring your workforce and restoring your salaries, all those items you now have up until the end of the year. If you've been in a situation where you weren't going to be able to spend your funds over the 8-week period, now you've got an extra, what is it, 16 weeks, up to 24 weeks to do so. A lot of favorable items in this. There is one small glitch in the bill, but I don't think it'll really cause any issues. There's already a technical correction legislation being drafted at this point too. So even if it were to cause any issues, I think that'll be corrected. Just on the housekeeping side of this for the presentation, if you do look towards, I think it's the bottom of your screen, there's a Q&A section. If you do have any questions throughout the webinar, you can feel free to post those there. We might not be able to get to those on the live webinar here, but if there's any questions that don't get covered throughout the presentation, we're going to look to try to get back to you on those, or feel free to reach out to us directly after the presentation as well. So getting started on this, again, PPP Flexibility Act, we're going to just jump right into, we're assuming that everyone here knows how the PPP came into play with the CARES Act, and you already have your loan. We recently had a presentation going over the forgiveness application. You can find that on our website or our YouTube channel if that goes a little bit more in depth into the PPP program in general. This presentation will just touch on the actual provisions of this recent legislation. Just disclaimer, everybody's business needs are different, especially with a loan program like this. It's very touch and go, fact-based circumstances as to how you want to plan that. So definitely, consult with us or whoever your accounting or attorney professional is, based on your circumstances. So we're going to go pretty much in order of the bill. And just to bring it up briefly too, I'll bring it up for reference at another point, but this is a very small, this is the engrossed bill version. I mean, as you can see, it's a very small bill, so there's not too much meat to it. But that being said, even though it's small, I think it brings some big favorable changes. So first piece, loan maturity was extended. So the CARES Act allowed up to 10 years for repayment of any amount not forgiven, but the SBA came out afterwards through guidance, and we saw it on early on that they were going to change it to a 2-year term for repayment. So Congress, through this bill, they came in, they said, 2 years might not be enough, so we're going to push that out to a 5-year term. Something to keep in mind is that this 5-year term is, essentially automatic for any PPP loans that are entered into after this bill is signed. For anyone in here that already has a PPP loan, pre-existing loans can be modified to adopt this 5-year repayment term upon mutual agreement between the lender and the borrower. So as I put here at the bottom for the questions, I'm not sure if we're going to see, lenders actively reaching out to the borrowers to say, hey, contact us if you want a 5-year term. Similarly, I don't know if there'll be any pushback from the lenders at this point. I would think, or I would at least hope, that they'd be accommodating for this change. When you signed your loan, it most likely at this point says 2 years. So you'd have to reach out to the lender and to have those terms amended. But in general, that's favorable for any new borrowers. And if you're able to negotiate that going forward for your existing loan, that'll help as well. Hopefully you'll be able to get 100% forgiveness and you won't even have to worry about the loan term, but it's there if you need it. The covered period is extended. So this is probably one of the biggest headlines that we've seen on the bill. So the covered period was that 8-week period you had from when you got the loan to spend your expenses, to track your comparable amount of full-time equivalents, to track, have you been keeping up with your salary, wages levels versus pre-COVID. This bill has pushed that 8-week covered period out to a 24-week covered period. So this is a much larger amount of time. So where this really helps is for any borrowers that, you know, I know we have a good handful of clients, or even, you know, just other borrowers in general that are running up on their 6th week, 7th week, maybe about to enter into their 8th week soon. If you're in that position and you found that, you know, you tried to retain as many employees as you could, maybe you were even paying them for not coming into work, but you're not sure if you're going to be able to spend those funds in time by the expiration of your 8 weeks. Now you've got this 24-week period, which gives you plenty of time, well, comparatively, plenty of time to spend the funds. For any of those that, if you think you're in a good position though, where you think you've already spent or you're going to hit spending all your funds in the 8 weeks, maybe you've already calculated out your FTEs, you're confident that you've restored your salaries, and you think that you're ready for 100% forgiveness now, and you don't want to have to wait months down the line. While we don't know exactly, you know, when you can walk in and submit for forgiveness, there will be an election where you can elect to retain the 8-week period. So again, this would probably benefit more those that are, you know, right on the cusp of checking all the boxes at this point. And like I think a lot of people want to, you probably just want to submit this in and kind of put PPP in the past. So this will be, you know, a business by business decision where you'll have to look at where you stand as you approach your 8 weeks. Do you want to cut it off there? Do you want to go for the 24-week period? Along with that, you'll have to keep in mind too, that if you go with the 24-week period, you'll likely have to measure your FTEs over the full 24 weeks. You'll have to compare your salaries and wages over the 24 weeks. You know, there is the safe harbor provision, which we'll get into, which kind of alleviates that, but it is, you know, just from a record keeping perspective, it's something to keep in mind. And just to keep in mind too, you would have to have, unless you've, you know, increased your payroll, you may have run into an issue where you weren't able to spend it all over the 8-week period. And that's why the 24 weeks works as well, even for those that have been retaining or paying employees not to be working. Because to take a step back, if you think about how this program was really laid out when it first came out, the idea was, you know, here's this PPP loan. We want you to keep your workers so that in 2 months, when everything is, you know, everything in the economy is back and working and COVID is in the past, you'll have your workers there ready to go. Unfortunately, some of these people that came in early that, you know, this was a first come, first serve, continue to pay your employees even if your doors are closed. The people that applied that spirit of the loan, maybe you've used up a lot of your proceeds over this, you know, 6-7 weeks or so. And now you're finding that you could have spread that out over 24 weeks. It really is unfortunate where some people coming late into the program are going to have a bit more flexibility than those that were there from the start. Right now, there's really no relief to that. This 24-week extension doesn't give you more funds to use. It just gives you a longer amount of time to spend them, which I'm sure planning wise, you know, in hindsight, if you knew that you're going to have 24 versus 8, you probably would have managed the funds differently. So again, it's kind of an unfortunate position of the way this program has been rolling out piecemeal, little little bits at a time. Just a kind of some questions to consider. Will the alternative covered period be adapted for the 24 weeks? For a 24-week period, I'm not sure that that's really even too relevant at that point. It's probably maybe the alternative covered period. This was the one that allowed you to align your 8 weeks with the first day of your payroll to kind of keep your 8 weeks cleaner. Maybe this is still good for those that are planning to do the 8 weeks to make sure that you get all your payroll in time. And then one of the bigger questions is that 100K per employee, the cash compensation limit, going to be adjusted based on 24 out of 52 weeks, or is it going to stay at the 8 out of 52 weeks? So what this is we saw with the forgiveness application and one of the IFRs before that as far as how much payroll you can actually pay your employees over what was 8 weeks, you could pay up to $15,385, which if you annualize that over a 52-week period, that gets you to 100,000. So the question now is, can you now spend up to 46,154 per employee based on a 24-week over 52 weeks? Right now, we really don't have a direction either way on that. I'd say if you want to be conservative on it, just cap at the 15,000 and wait for additional guidance. I know we hate that phrase, to wait for additional guidance. I'm guessing that some type of FAQ will address this, or maybe even just through they'll have to revise the forgiveness application. So it may be mentioned in there as well. There was also the calculation for forgiveness for self-employed individuals, as well as the limitation where owner employees cannot get compensation that exceeds 8 out of 52 weeks times, their 2019 pay generally. And will this be adjusted as well? Overall, though, this 24-week period with the election to retain the 8 weeks is very flexible for borrowers. This will give more time to spend the funds, but if you want this, if you're ready to get this thing off your plate, you can still use the 8-week period. The safe harbor date was extended. So as we discussed this in our previous presentation, where after you've gone through and you spent your PPP loan on payroll costs, your mortgage interest, utilities, etc. You've determined how much of those expenses are forgivable. Then you have to look at your FTE, your full-time equivalents during your covered period versus a period prior to the coronavirus crisis. And then you also have to look at the level of salary and wages paid during the covered period versus this pre-COVID period. And if you have a decrease in FTE, or if there was a decrease in salary or wages paid, this could impact and reduce the amount of loan forgiveness that you would receive on your PPP loan. However, there was a safe harbor that was in the CARES Act that was further flushed out in the forgiveness application, which allows you to look at your levels of FTE and pay on February 15th, and then compare that to June 30th. And if you're able to restore, and I'll get into whether it's by June 30th or before, but it was through the application, it seemed like if you were able to get your February 15th levels restored by June 30th of 2020, then you were safe harbored. You were not going to have any reduction in the amount of your loan forgiveness for a decrease in FTE count or a decrease in wages. This recent legislation pushed that June 30th date out to 12/31/20 to the end of the year on December 31st. So in a good sense, this is nice because now, maybe this PPP loan has helped you out, but you haven't been able to really get back up and running. Maybe you haven't been able to fully restore your workforce or the pay levels quite yet. And maybe you don't think by the end of the month you'll be able to do so. Have until the end of the year, December 31st, to restore those FTE and pay levels. And if you're able to do that by that time, then then you'll be safe harbored and your loan forgiveness will not be impacted. Now, one of the items here though is this going to be on a, as I describe it here, a not later than 12/31/20 standard or an as of December 31st? So if you look at the way that it's worded in the forgiveness application, again, this was based on the old rule, the June 30th rule. It seemed like it was saying you need to have your February 15th levels as of June 30th restored. So did this mean, on the day of June 30th, your FTEs and your pay were restored? Did it mean during the pay cycle that included June 30th? We weren't sure. A couple days after the forgiveness application came out, some forgiveness regulations came out, and it described it more as a not later than. So I'll have another slide on this a little bit later on, but it basically said you had to restore your February 15th levels no later than June 30th. But if you were able to do it earlier than that, that you still met the safe harbor. So what does all this mean? So in other words, I'm interpreting this to mean that you can restore your February 15th levels. You don't have to wait all the way until December 31st to get that safe harbor. That at some point between February 15th and December 31st, if you're able to restore. Now the question is it, say July, you were able to get your counts back up to February 15th levels. Do you have to hold on to that for a week? Do you have to hold on to that for a month? What actually means that you were able to do that before December 31st? We're definitely waiting for more guidance on this, whether through an FAQ or from the wording that they put in the application. It's something to consider when you're planning around this. I don't think you're going to have to wait all the way until December 31st, but we aren't quite positive at this time. I think it'll be something where if you can get to that point before the end of the year, then you'll be good to avoid these reductions. But for anyone that can't, if you think it is going to take you until the end of the year to restore that, you now have an extra 6 months to get the business back up and running, beyond even your 24 weeks to get your FTE count and your pay back up. So that was definitely favorable. This is another big one. So the FTE reduction exemption was expanded. It wasn't per se that there was an exemption before. There were some exceptions before in the application that said, if you tried to offer, this goes back to if you had a decrease in your FTEs during your covered period versus your pre-COVID. So there was an item that said, if you try to offer to the employees the job back, they decline it. If you document this and report it to the unemployment offices for your state, that you would not be impacted by that employee. You'd get to restore the FTE number for that employee. So if you had 10 employees before, you got 9 now, you tried to hire back the 10th one, they decline it, you document that, report it to unemployment offices, then now when you compare it, the SBA will consider you to have 10 before and 10 after. That's what that exception was. And there were some other exceptions as well. That was kind of the big one. The reporting to the unemployment offices was explicitly mentioned in the guidance that came out a few days after the application. Last I checked, I haven't seen anything on the SBA specifying how this would be done. There was a footnote in the guidance that said the SBA will be providing additional information on this. So that's where we were coming up to this bill. Then this bill comes in and it says loan forgiveness is determined without the reduction in FTE count for it's 2 items here. If you're able to document an inability to rehire individuals who are employees on February 15th and an inability to rehire similarly qualified employees, or an inability to return to the same level of business that you were operating at on February 15th or around that time due to compliance with requirements established by HHS, CDC, OSHA during the period of March through December related to the maintenance of standards for sanitation, social distancing, and other safety requirements applicable to customers and employees. So to kind of dissect that, it's saying that you'll receive an exception from this FTE decrease if you're able to show that you had a decrease in business activity because you were complying with the new social distancing or sanitation standards that have been adopted. So a lot of businesses that are starting to reopen, you're seeing that, you know, it's an uphill battle just to get people back into the office. You have to have masks, you have to have, you know, the offices have to be clean. What kind of PPE do you need? What considerations do you have? Are the clients even or customers even allowed inside? How many people can you have? This might be, you know, a state by state determination. You can have up to 25% of your workforce in the office at a time, that kind of thing. So if, you know, because you were adhering to those requirements between March and the end of the year, if you weren't able to get back up to the same level of business activity that you were at before this whole COVID situation started in February, then this will give you an exception to the FTE decrease. So I think this is really big. I think pairing this with the safe harbor, it seems like Congress was really kind of saying, you know, if you can't get your business back up and running by June, we're pushing that out to the end of the year. I think there was you know, at the time of drafting the PPP, there was a really optimistic approach that maybe, you know, everything will be fine by the middle of the summer. A couple months will go by and then, you know, everything will open back up. But as we've seen, you know, even if businesses are starting to go back to work, it's going to take some time for the economy to really bounce back and for businesses to get to where they were before. So this exemption gives you until the end of the year. And if you can't get there, then you've got an exception. How you substantiate these will be, you know, I think we'll probably see some information on that come the next version of the forgiveness application. I don't know if this is going to be something where it's an employee by employee determination, or if it'll be, you know, check a box and self-certify that, you know, maybe it'll read off you had an inability to restore the same level of business, check a box and say that, you know, you believe this to be true, that kind of thing. So as far as the procedure on it, we'll have to wait and see. There'll definitely be some guidance coming out on that. The limitation on forgiveness percentage was adjusted. So the old provision here, so this was there was the 75-25% rule, where on the application, it said you had to spend, you know, 75% of the amounts forgiven on payroll costs, and then the remaining 25% could be on non-payroll costs like utilities, mortgage interest, those items. So at the time, it was of the total amount forgiven, 75% had to be on payroll costs, which meant if you took out a loan for $100,000 and you spent $50,000 on payroll costs, you could still get forgiveness. You just, you know, because you only spent 50% on payroll costs, the amount of total forgiveness would be reduced pro rata. So in a good sense, they changed this ratio to be a 60-40 split. So now you can spend up to 40% on non-payroll costs, but you have to spend at least 60% of your loan proceeds on payroll costs. So where this differs from the old provision is there was no requirement that you had to spend at least 75% of the total loan on payroll costs before. The new bill kind of brings in that you have to spend at least 60% of the total loan on payroll costs in order to get any forgiveness. There were some senators that, you know, they wanted to get this bill passed through, but they had some current concerns on this provision. So there's already a technical correction bill being drafted on this so that it doesn't become a hard cliff, because as it reads right now, it seems like, you know, if you spend 59% of your loan on payroll costs, then you get no forgiveness. And I don't think that's really the intent or the spirit of the program. That being said, I think for those that opt to go for the 24-week period, you've now got, essentially 24 weeks to spend 60% of what was only 2.5 months of payroll. So you got to spend, what is that? Something like 6 weeks of payroll over a 24-week period. Hopefully you're able to reach that point, but it's something you'll just want to keep in mind. You want to, at least until something else comes out, you want to make sure you're at least spending 60% of the amount of the loan you got on payroll costs to avoid this cliff effect. You'll, again, likely over the 24-week period, you're going to hit this amount, but it's kind of a number to keep in mind that you want to at least get to that piece. Then the loan repayment deferral period was also adjusted. So this is the, when you took the loan, you had a 6-month deferral before you had to pay back any amounts that are not forgiven. Again, we're hoping that, people will be able to get 100% forgiveness with all of these changes, but the new provision comes in and it kind of adjusts that to say it's deferred until either the forgiveness amount is remitted to the lender, or if the borrower, or otherwise, if the borrower has not applied for forgiveness, then it'll repayment starts 10 months after the end of the borrower's covered period. So if you think on this is advantageous too. So if you have a 24-week covered period, you submit for forgiveness, and then the lender has up to 2 months to make a determination and request the funds to cover that loan. You shouldn't be looking at probably anything less than 6 months. For those that don't apply for forgiveness, or if you want the max amount of time, you can wait 24 weeks, your full covered period, then another 10 months from that point, and then that's when you would have to start to repay. So especially that second bullet there, the later one, pair that with the fact that it's a 5-year repayment term. If you're able to negotiate with the lender, you're looking at nearly a 1-year deferral with a 5-year repayment term at 1%. Again, we hope everyone can get 100% forgiveness, but if you're not able to, those are pretty favorable terms that they've adjusted through this bill. Another good one that's this has been kind of flying under the radar, because this has been currently available, but under Section 2302 of the CARES Act, an employer may defer paying the employer share of Social Security taxes during 2020, and 50% of that amount is due December 31st of 2021, and then the other 50% would be due December 31st of 2022. A lot of, if you're using a payroll provider, a lot of the payroll service providers are able to adjust this in their system to account for this change. The old provision was that if you had a PPP loan, you could still get this benefit. You could still defer the employer share of Social Security taxes. However, once forgiveness was received, you had to stop there. You couldn't continue to do so. This act, the PPP Flexibility Act, this allows you, even after forgiveness, to continue to defer that share of Social Security taxes. So now this benefit is available for the full 2020 year, even if you get loan forgiveness. You do want to be careful of how much you're deferring. Keep in mind that it's not that you don't have to pay it ever. It's just you're kicking it down the road. So if you think you're in a position now to pay it, that being said, if you think you could use the additional cash and you'll be in a position to pay that next year or the year after, then you can do so. But again, it's the name of the act. It's given more flexibility to these borrowers to be able to use this provision. It's another source of holding on to some cash if you're tight there. It will eventually become due, though. As I mentioned, there was some guidance that came out a few days after the forgiveness application. So this isn't related to the act itself, but I just wanted to touch on some key items that came out of that. First was that the salary and wage reduction only applies to a decline in the rate of pay. So if you're if the amount that you're paying your employee over the 8 or the 24-week period goes down versus the period you're comparing against, if you're at least paying the same hourly rate, then you will not be, you don't get any, there's no adverse impact when it comes to the salary and wage forgiveness piece. So if you were paying someone at a rate for 40 hours a week, and then during the 8 or 24-week period, you're paying them for 20 hours a week, so they're getting half the pay. As long as they're still getting that same hourly rate of pay, you're not going to get hit twice. You're not going to get hit both for a decrease in your full-time equivalents and in the pay. So I think that's really helpful. I think as long as you maintain, again, that same rate of pay, you're good on that front. The guidance did confirm salary, wages, commission to furloughed employees are forgivable costs, as well as you can pay bonuses up to what was that $15,385 number per employee that we'll have to see if that gets adjusted, as well as hazard pay. So if you do have some employees that are maybe working, during this time, and either you wanted to, you don't think they're going to hit that full 100,000 mark during your covered period, you have some room to pay them some extra and have that amount forgiven. And then, as we mentioned before, in order to get the exception where you try to rehire an employee but they decline, in order to get that exception, you must notify the state unemployment office within 30 days. The SBA is supposed to release additional information on this procedure, but it hasn't really come out yet, at least when I had checked that yesterday. And then just wrapping up, we've got, there's probably some more to come. We at least have to have a new forgiveness application to reflect all the changes from this legislation. There is about 30 FAQ guidance that was rumored to come out over the last week or so. I think they held off on releasing that because of this bill, and they saw the changes that were coming. So hopefully it's a matter of just adjusting those FAQs to account for the new changes. I'm not exactly sure what the content of that would be. 30 does seem like a big number, so hopefully it's helpful. And then there may be additional interim final rules or essentially regulations to adopt the changes in this bill too. Legislation-wise, like I said, that 60% cliff effect that seems to be in this new bill, they're already drafting technical correction to that to try to get that fixed. Along with that, there's an attempt to get PPE included as a forgivable cost. As we've said before, you kind of got to play with the program as you have it. So I wouldn't rely on, the idea that you can use PPE until something actually passes that says you can. There's also a bill in the Senate that's been getting more co-sponsors, which would restore the deductibility of expenses paid with your PPP loan. They actually tried to fast track this bill yesterday, but that wasn't able to go through because some Congress members are weary of being able to essentially double dip to get tax-free forgiveness and to be able to deduct expenses. It seems like the rumor is that they'll try to take up this issue through what would become a fourth round of stimulus legislation, but this bill is out there by itself as well, so maybe they'll try to get this one through. No guarantee that we'll get the deductible expenses, but it does seem like there's motivation and growing concern over restoring the deductibility of the expenses. And then automatic forgiveness. This would be, some would say it's a pipe dream, but there's some bank trade organizations, basically, essentially run by members, financial institutions, have submitted a letter requesting that PPP loans of less than 150,000 automatically be forgiven to relieve the banks of having to process all of these applications. Again, there's another one where until it actually happens, I wouldn't hang your hat on it, But it would be nice. So if you are a borrower that had, you know, a smaller loan, maybe that 150,000 will, you know, get adjusted. Maybe it would go down or up. But if you were somewhere in that ballpark of that amount, there's a possibility that, you know, you won't even have to really dig into the details of everything to get forgiveness. That being said, right now, there's no bill or anything that I've seen to actually to implement this request, but this was something submitted this week on behalf of the lenders to hopefully expedite the process of forgiveness. So I think that would be helpful. And I think at a some type of de minimis level, like 150,000, I think that would be a reasonable, you know, not that I get to set the rules, but I think that would be a reasonable way to approach these loans. But that covers it today. Just wanted to get a, you know, a quick reach out to everybody, let everybody know about the changes in the bill. I know we kind of flew through some of these here. Definitely, if you sent a question, the Q&A, we'll be looking at those after. Feel free to send an email to any of us here. If you want to look at the act itself, we've got a link for the PPP Flexibility Act. That was, you know, the 3-page bill. We've got a link to the Treasury guidance page, which lists out all the different guidance that's come out on the PPP loans. And then a recording of this webinar, as well as the slide deck, a PDF of the slides will be available at our ocd.com webpage as well. So I just want to say thank you very much for all of you that attended. Hope you have a great rest of your Friday and a great weekend. And hopefully the PPP program continues to work in our favor. Thanks and have a good one.